Hi everyone, thank you for tuning in. In this video, I'm going to do a brief review of fuboTV's third quarter results, so let's get right into it. fuboTV is a streaming alternative to your traditional cable TV subscription, and the losses are piling up on the bottom line for this growth company. Overall revenue increased by 43% in the third quarter to 224.8 million. However, the net loss also increased to 152.7 million, which was worse than the 105.9 million in the same time last year. This is the opposite of what I like to see as an investor. I like to see when revenues are increasing, the profit margins are increasing, or at least if you're a company that has losses on the bottom line, I want to see the losses shrinking as revenue is increasing. I want to see economies in scale, which I'm not seeing here for Fubo TV. Subscribers in North America increased by 31% to 1.2 million. An acquisition of a French streaming company added 358,000 international subscribers, and it's helping the company expand from just a domestic streaming company to an international one. The fourth quarter guidance calls for 1.36 million North American subs, which would be a 22% increase year over year. That's impressive because the company has, at least lately, started increasing prices, starting to bring customers along to the higher average revenue per user type of subscriptions, and that's a big deal because subscriber related expenses were 214.5 million in the third quarter. That's compared to overall revenue of 220 nearly 225 million, which also included advertising revenue. So the company is paying almost as much for the content that it's getting as it's charging customers for. And that's not going to be a sustainable business model longer term. Fubo TV needs to increase prices on customers, or it needs to achieve a large enough scale to where it can go back to these content producers and say, hey, you guys, if you want us to show your channels to our subscribers, you need to offer us a lower price. And so that way the spread between what it's charging customers and what Fubo TV is paying for the content can grow in its favor instead of working in the opposite direction. This is what's leading to the massive losses on the bottom line. To support all of these losses, the company issued new shares, and the number of shares outstanding have increased to 106.75 million. This was up from 142.5 million year over year. This means that when the company does eventually, or if it eventually becomes profitable, those profits are going to be spread out more thinly because it's adding more shares to its shareholder base. Cash and short-term investments, the company had 301 million, and it held 309 million of convertible notes debt. And this is a little bit risky because the cash from operations was negative 294 million for the 9 months ended September 30th. That was worse than the 143 million in losses during the same time last year. That means at this pace, in the next 9 months, Fubo TV could run out of cash if it keeps losing this much money and does not raise new capital. Now, I'm not saying that's what's going to happen. The company will probably find a way to raise new capital before that point, either through debt or issuing new equity. But the fact that it's losing this much in cash every 9 months is troubling. And that's partly why I would like to see them raise prices further in order to bring their equation into a better balance, in order to bring the business into a more sustainable long term trend. The way it's going right now, this business is not sustainable long run. I want to see them raise prices. I want to see how many customers leave after they raise prices, because typically when a business raises prices, it causes sales to go down. But that's okay if sales do not go down as much as the price increase goes up, right? So you don't want to see a one-to-one decrease. And that's the evidence that investors like myself want to see with Fubo TV. I want to see them exercise some pricing power to bring the business into a more sustainable level. As it is right now, I would not recommend Fubo TV stock as a buy. It does have a long term tailwind because streaming services are so much more convenient than a traditional cable subscription. and they're a lot less expensive than a traditional cable subscription. But in the short term, the business model is not sustainable with these massive losses on the bottom line. I would like to see Fubo TV bring their revenue and expenses into a better balance before I could recommend the stock as a buy. All right, so that's all I've got for Fubo TV earnings review update. Thank you for watching, and if you've gained some value from this video, please go ahead and hit the like and subscribe button. It'll help me make great videos like this one, and I'll see you next time. I want to thank the Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for all investors of all skill sets and risk levels. So I'm proud to partner with the Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market by more than 3 times. Go to fool.com/Parkev to get your 10 stock picks now.